Hello, everyone. We are back today talking about chapter two, the second part to it. Now, chapter two is not really that long. We're what we're trying to get through is the master strategy and tools because chapter two talks about strategic planning and strategic management. Often that means setting a mission, a vision, and value statements, how you're going to get there, what you're not going to do. So, in order to get there, uh, let's just go back to it. Whoop, let me share. All right. Oh, great. And now we're all messed up. There we go. Whoop. Why is that doing that? Let's try that. Oh, that's what's going on. Let me get out of here quick. Sorry, guys. Okay. So we left off at the Ansoff Matrix. This is the document. It's in contents on D2L and go down to Bruce's doc and or docs or documents or whatever it says. There's only one in there as of right now, summer 2025. If there's others, that's fine. And this is titled Master Strategy Tools. So what we're doing, if you pay attention here, is Chapter two talks about developing a mission, a vision, and value statements. And my argument is, how about we do all these other tools and discuss that before we get to developing a mission or a vision and value statements? Because without the knowledge that might be found in all of these other resources, setting a mission and vision, it might totally change things. And I believe we talked about value disciplines before. If those aren't taken into considerations, I've seen too many times with managers that have just they go in all directions, and it's not it's not they're not trying to do evil. They're trying to do the best they can, but they're unaware that it's well, you're taking it in the wrong direction. So that's why these tools I think are so important. Okay, so we left off talking about the life cycle or product life cycle. We left off at, come on, boy, we might be having a hard day today. Let's try this again. My sincerest apologies. All right, let's try this again. So we're going to go through all these tools. We left off at the Ansoff Matrix. We had talked about the product life cycle and how important that is. Knowing what that life cycle is tells us what the financials should be. Um, Now, if you get into a company that's a conglomerate like 3M, well, in portfolio management theory, they can break down each product line into its own sort of business or own department. And then the idea is the same in the product life cycle, and aligning things is kind of the same. Very similar. We talked about launching the 2.0 versions, and a company should never be in the decline phase of business. I would say, though, from the standpoint of an investor, all companies grow, they mature, and they decline. Okay. But it is true, a company is not, they should be hiring someone to keep them out of that. But that gets us into this life cycle structure. I was talking about my church and how strategic management is done in that growth cycle once a pattern has been determined and you're trying to scale it is the new buzzword that we talk about. So you figured out how to do it as well as you can, and then you go out and you try, uh, yeah, scaling it, getting it bigger, producing more. But what happens if you're in a business or a company and we wrap around and now we're declining and we've chosen maybe it's we're a product leadership discipline organization and we're getting killed by businesses that are operationally excellent. So they're the low cost producer. And for whatever reason, we are struggling to compete with those low cost producers. Then the question is, well, what do we do? And one of the things we have to ask is, do we go head to head and compete with the low cost producer? Or do we try to figure out a new niche that's with our products in order to continue on that product leadership discipline, which is probably the safer. Normally, it's the less risky strategy. But if you haven't found a way to do that yet, then it can turn into crisis into confusion. And to get out of that, you need transformational leadership. You need someone to come in that's usually right brained versus left brain. Left brain managers are great at strategic management, right brain are much better at transforming. Then we try to figure out, well, what are our options? And then selecting an option and testing it out, which is entrepreneurial. And then we figure out, yep, this works. Then you're in the growth cycle again, and you're in the strategic management function where you scale it. So I really like that diagram. That's helped me out a great deal. And that gets us into the Ansoff Matrix. First and foremost, we need to go back to, do companies have to grow? And that is a presupposition or an assumption that is there, that the company has to grow. And I'll ask this in a normal semester, and I get a lot of students that kind of shake their head. Yes, they have to grow. They can't choose not to grow. And why is that? Well, because they'll die. And well, what do you mean they're going to die? If you're Nick's Hamburgers, is Nick's Hamburgers, if all they do is make hamburgers, they don't need to add on to uh, to the menu necessarily, because people don't go there to get new items or new things on the menu. But that fundamentally gets to the heart of it is, well, does a company have to grow? And I think the answer is yes, because if a company is in a competitive environment, and as Michael Porter states, if profit margins are high, then in competition is also going to be high, and you're going to get a lot of new entrants. You're going to get other companies that might have been suppliers of raw materials trying to enter into that. You're going to have forces. Once you have those forces acting on you, then in order to even exist, you have no choice. You have to grow. So I say this because, again, if you read every business textbook out there, there's two assumptions. One of them is you're trying to create a competitive advantage, a sustainable competitive advantage. And two, that would mean that you have to grow, because if you don't grow, your competitor is going to come get you and eat you. So that gets us to the question, well, how do we grow? And again, you have to remember that people running a company aren't intentionally trying to go in the wrong direction. Okay, they're doing the best they can. They're trying to do what they think is right. But we use something called an Ansoff matrix to help us better understand the pathway we should go and the one we should maybe avoid. So that gets us into these four quadrants. I think it's Igor Ansoff. I don't know a lot of background on him. Created this diagram to help understand really the level of risk associated in business. And many of you, I'm sure, have heard of risk and return in business. Those are fun. Those are presuppositions. As the higher the risk something, the higher the rate of return that's needed to take on that risk of that investment or that project or that business line, whatever. So Igor Ansoff created this. I love using it because it helps me to mentally and visually figure out what level of risk are we dealing with. So over here, actually, if you look at both of these, you'll notice on the X and Y axis, both of them are risk. So the how you're changing is what changes. Anyway, okay. So if a company wants to grow, its first option would be to find ways to continue to sell the same products to our same customers. If you're J.C. Penney's, one of the best ways to do that has been to offer up the buy one, get one free or a 50% off discount. That has worked. And maybe they have a super sale or something like that. So the people that buy at J.C. Penney's anyway are going to come in and they're going to buy some more because now there's a clearance, now there's a discount. And maybe they would have, maybe they wouldn't have gone in to shop in the first place. And if they didn't need anything and they just wanted to get a good deal, maybe that they're in then, so they are buying more than they would otherwise. That's called market penetration. So you're trying to sell the same products to the same customers. The next way we can grow is what Igor Ansoff called market development. Now, market development is you're selling the same product, but you're selling it to a new group of people. So I like to use Gillette razors. Gillette razors is in 1995, 6, 7, 8, somewhere in that time frame. They came out with a razor called the Mach 3 razor, and it was the first time a razor, straight edge razor manufacturer put three blades in a thing. And then it kind of got comical because then it went to four blades and then it went to five blades. And they haven't done more than five blades. But using Gillette as an example, you can understand and see what how a company can grow. So if Gillette creates the Mach 3 razor, they saturate the United States. Maybe it's now time to go to Australia, or maybe it's time to go to Germany or other places and try selling the same Mach 3 razor to those folks over there. Okay. So that's market development. Same product, new group of people you're selling to. Another option for Gillette would be product development, and that's what they did do. Is after they created the Mach 3 and they had so much success, they went on and created the Mach 3 Turbo, then the Mach 4, and then it turned into the Gillette Fusion or Gillette Glide or all of these other types of razors. Well, that's an example of product development. So they're trying to sell a new and improved, a better product to the same customers that originally bought the Mach 3 in this case. So the Mach 3 was so good, it's like, well, four blades must be better. Five blades must even be better, and maybe it's a better shave or it's smoother or faster or whatever. So Gillette took the option of market or product development. Okay, keep selling new products to the customer. It did kind of work. They had a number of them. The Turbo one, the Mach 4 didn't work. The Mach 3 Turbo didn't work. But the original Mach 3 that was created in 1997, 8 time frame, or introduced is still a very popular razor, and I think it gives a pretty clean shave. So that's product development. Now, here's the last one, and this is going to be a test question, and it's going to be that which you should know until the day you die, just like sustainable competitive advantage. Because I find with students, I am having to routinely get them out of this idea of diversification. I think what's happening is they take a finance course or investing or personal finance, and in there they get told that, well, diversification is good and you don't want to put all your eggs in one basket. That is good advice for the principal. It's not good advice for the agent. And I'm going to stop here for just a second and pull up a new diagram for you. Okay, so I didn't have the PowerPoint slide that I thought I had. Um, so we were talking about the fourth quadrant, which is diversification. And as I was saying, diversification is fine if you are a principal. A principal is an investor. That's Warren Buffett. That's, if you have a 401k plan, you're an investor. That's when you should diversify. Okay. Now, when we talk about a company, diversification is usually not a good strategy. In fact, it's the worst one. It's the one you should avoid, or it should be assumed you should avoid it. Why? Let's go back to our diagram here. Okay, when we're going through these things, the life cycle, and you're declining and you're going to transform, you're working in the world of the unknown. You don't know how to do this yet, or you maybe don't know how to do it well. Maybe you're trying to, produce a new app and it's not catching on. So you're trying to figure out, well, what do we need to change? How do we need to do this? And that is time consuming and it's very costly. Most businesses are like that, that you're trying to learn. It's about knowledge and power and competition, and it's not, yeah, necessarily about an income statement. So when we look at that, the less you know and know how to do equates to higher levels of risk. Okay. The purpose of an agent, a CEO, a person running a company or a department or a division, their job is to not diversify, it's to scale. Okay. It's to be left brain, strategic thinkers. How do we get this bigger and grow more and sell more of the same thing we're always doing? So that's about getting good at something. When you diversify, you're going into something you don't know how to do. So if that happens, then you don't have what's called a core competency because you haven't figured out any competency yet. So again, I say that because you need to have it seared in your mind that it is not the job of the CEO, not the job of the agent to diversify. It for investors, that's fine. But for agents, this is Marissa Mayer. She was the CEO of Yahoo. I couldn't find another famous one that I knew of real quick. She's an agent. When she worked for Yahoo, she got hired in to go run Yahoo for 5 years or whatever it was. When she does that, her job is not to diversify, it's to figure out what is Yahoo really good at? What do we know how to do? What do we know how to do that others don't know how to do? And now, how do we do more of that? Okay, that's strategic thinking, that's strategy. If you want to transform, then you get into the world of the unknown. And again, you have special agents or CEOs or people leaders to come in and to do that typically. But again, that should not be your first move is to diversify. I get really amped up about this one because when I talk to students, the number of times I hear the word, well, maybe this company should diversify, and I just want to throw something at them. No, that's not where you start. You can end up there and you can, because you have no other options or no other choice, but you do not start there. All right. So we have these four quadrants. If a company needs to grow, it can try to sell more of the same product to the same people. It can go sell the same product to a new market or new group of people that it doesn't currently sell to, or it can develop a new product and try to sell it to the same people. These have risk associated with it because there's unknowns. Doing the product development, just because they bought the first product doesn't mean they'd buy a second product. The market development, maybe because it worked selling it here in the United States, you think it's going to work in Europe or Africa, and it might not for one reason or another. So those are higher risk. Diversification is true diversification in business is you're selling a completely new product to a completely new set of customers. So when we talk about Gillette and razors, I use an example of, and mind you, this is a 10-year-old analogy, so things have changed. But when Gillette, if they wanted to diversify, okay, complete diversification from what they're currently doing, well, what do they currently do? And we know they currently make really good razors, sharp razors, okay? So if you had a group of executives in a room and they're trying to figure out, well, where do we go next? They could try selling the same razors they have in Europe because they don't currently sell there. Or they could come up with a new product, a new razor. A diversified strategy, though, or an example of one would be, well, what if they started creating electric razors, which I don't think they might today. I don't know, but we're going to pretend that they don't sell electric razors. So, selling an electric razor to veterinarians. In both of those cases, they've never sold anything to veterinarians and they don't know how to make electric razors. They're not good at it. So, for them to get good at that is going to take a long time and it's going to take a lot of money. It would make more sense instead if they try to figure out a strategy that is lower risk. Now, maybe they figure out like they've saturated the market, they've sold on every continent in the world other than Antarctica, and everybody has a Gillette razor you're not going to sell anymore. Well, maybe then a diversified strategy might be worthwhile. So, another idea of a diversified strategy is similar to the value disciplines and changing your value discipline. That's the equivalent of it. And that is a no no. You don't do that unless you're at the end and you have no other options. There just aren't any other good options. You're going to have to change. And that goes back to our diagram of, well, then you got to transform and you're going to be a lot of learning, which is not, you can't get competitive at something because there's too many unknowns. Okay, so that's how we use the Ansoff matrix. And we have a couple different of these. In this diagram, they create partial diversification, limited diversification, and excuse me, partial market diversification, partial product diversification, and then full on diversification. I don't know why they changed that back to, uh, excuse me, back to blue. It should be red hot, like don't do it. Because again, you don't know how to do it. It's going to cost a lot of money to figure out how to do it. And boy, if you're going to do that, it better be worthwhile. Like you better be able to sell hello, lots of units. Okay, so that's the Ansoff matrix, and it helps us to understand where we should go. Later on, you guys are going to do a project and you're going to use an Ansoff matrix. That's how you're going to tell me what direction to go. Okay. Now, when we do this, I am not asking you to create a diversified strategy. Last semester, I had some students that thought you're supposed to fill in ideas for all these. We're not even going to talk about a diversified strategy unless the company you're doing an analysis on has, they're dying and they have no other options. Unless that's the case, you will only ever do a market development or product development diversification. Okay, now this gets us into what I call aligning business strategy and financial strategy. This is the thing that I would say I do quite a bit different than most other instructors or business instructors. And to me, it is one you must know if you're getting a degree in business. Before we get there, though, I need to stop and run to the little professor's room. I'll be right back. All right, we're good to go. Let's go ahead and share. So, we're talking about aligning financial strategy and business strategy. Business strategy is it's a strategy developed around the idea of competitive advantage or sustainable competitive advantage. That's what you're trying to achieve. Financial strategy, you develop a business strategy first, then you pair that up with a financial strategy. Okay. It's the business strategy should be driving the financial strategy. Unfortunately, in many companies, it gets all out of whack and the financial strategy starts taking over the business strategy for one reason or another. So I'll dive deeper into financial information because you need to understand how it is companies go out and they do capital budgets trying to figure out of all these options that we have that you find in the Ansoff matrix, which ones, what based on what we've currently sold, which of those options are is maybe the lowest risk, therefore that's the one we should maybe choose. And then you create a capital budget based on that, and we figure out, well, how much of a rate of return do you need on that investment? So when we talk about NPV, net present value, in capital budgets, we're trying to figure out the investment. Is this worthwhile to do this given a certain level of risk? So we'll get all into that later on. Right now, I just want to bring up an overview of aligning business strategy and financial strategy. So again, business strategy uh, is what leads the financial strategy. You don't, it's a financial strategy aside from a business strategy. So you have a business strategy and then you're doing whatever in your finance department. That's bad. That what ends up happening is you create the tail wagging the dog. Okay. The finance department should be basing everything what they're doing off of the business strategy. So here's the idea. So a lot of times is we talked about with Gillette, if Gillette's executives need to grow, they decide they're going to come up with a completely, totally diversified strategy. They're going to sell electric razors to veterinarians. They don't sell either one of those. The business risk of doing that would be the highest level. Okay. That's what the Ansoff matrix is telling us. Both of these are risk. This is product risk. This is market risk. Diversification is the worst of both of those, or the most risk of both of those. So if Gillette was to create an electric razor to sell to veterinarians, that would be an extremely high business risk because it's a diversified strategy. So if the business risk is high, the financial strategy should be low, very low. Okay. The highest level business risk is the opposite of the highest level of financial risk. Now, when we talk about finance, guys, just a quick misnomer. A lot of students get really screwed up because when they're taking their finance classes, they're you're looking at the same information, but you're looking at it from different angles. Yeah, I need to show this. We'll hit pause here and I'll get you a diagram. Okay, we got it. Okay, so when we're talking about finance is analyzed. We all use the same metrics, but you're different people when you're looking at them. Okay. If you are a potential investor, so if you're Warren Buffett over here and you're looking to buy a company, Warren Buffett is looking for a good deal. He's trying to find a company that is undervalued. So if let's say he's looking at Yahoo, actually, let's just do this now. If he's looking at Yahoo as a potential business acquiring, try to find Yahoo's ticker symbol. You know what? Let's not do Yahoo because that's just going to take too long. Let's do General Electric because that's my gold standard. Okay. If Warren Buffett's looking to buy General Electric, what he's going to do is he's going to do a valuation. Okay. So when he looks at General Electric, he's trying to figure out, is this good? Is $252 a share good, or is that bad? Or is it a good investment, or is that a bad investment? Right away, when we look at the P/E ratio, that gives us an idea of whether or not it's overvalued. If the P/E ratio is over 16, then the stock is probably overvalued. So at 39, it's ridiculously overvalued. But Warren's going to say, well, we don't know though. We have to actually look at the earnings um, relative to the price that you're paying for the earnings. Now, inside a company, the CEOs, the executives do the exact same thing when they start looking at a product to expand their operation or to open up operations to sell the same products in a different place. There's risk associated with it. So the executive has to figure out, is this worthwhile? And they do the same thing as investors do when investors buy companies. So we're going to live in the land of make believe for the moment and say that General Electric is overvalued. So it's only worth $200, okay, not $252 a share. In that case, if you are the CEO of General Electric, then you've done a good thing. You've made the stock price, you've brought it up higher relative to the earnings. You've turned an undervalued asset, you've made it overvalued. So for the internal stockholders of General Electric, that's a really good thing. Okay. But if you're a potential investor, that's not a good thing because it's overvalued. Why would you buy it? When you set all things equal, the law of averages, then it's not worthwhile to do, to get into this. And over time, that equilibrium creates the equilibrium price of the stock. Okay, so we're going to say that General Electric is extremely overvalued. That's great if you're an internal stockholder and you're the CEO running the company, the agent, because you've done your job, which is to take an undervalued asset and make it overvalued. The fast, easy way to do that for most of us to understand is your job is to get the stock price to go higher. Now, That stock price going up may or may not have anything to do internally with the company. Okay. And if Warren's looking at buying General Electric, he's looking at the price, which here is $252 and some change, relative to what can be earned with it, which is $6.35. The earnings here does not shift. That stays the same. Most people don't understand that when they think business, they think, well, profits should go up and you want the earnings to go up. What they don't realize is, yes, that's fine, that's great, but relative to those earnings when the earnings go up, the price goes up in lockstep. Okay. So it's you're trying to get the CEOs trying to get the stock price up higher, knowing that the earnings are going to be steady or static or whatever. Okay. And that's where you get into game playing. And that's when financial risk and business risk, or excuse me, financial strategy and business strategy need to get into alignment. And this is the information you need to know. So when you're watching the Wall Street Journal or listening to the business news, things are starting to make more sense now is you have to understand the interplay between these things. So let's get back to our document. So when business risk is extremely high, then the company, from the agent's perspective, wants to have a very low level of financial risk. Now, this is where we get into multiple sides, well, two sides to a coin. Okay. So when I used to teach finance, I tried to explain this. If you imagine an organization, we often think of the pyramid structure of here's the CEO, here are the unit executives, here's the mid-level management, here's the frontline employees, and then you can divide it out and further. But we're going to use this diagram where you have that, but you also have an inverse or part of the organization, which is the investor class, the principals. So the principals are the owners, the agents, which usually are the board of directors and top management. Those agents are hired by the investors to run the company. When we're looking at the financial information, you're looking at the same data points or the same info, but you're looking at it from a different perspective. So, for example, if the company's overvalued and you're an investor or potential investor and you're looking to buy that company, well, you don't because it's overvalued. It's the same as if you found a $300,000 house that was selling for 600,000. You wouldn't want to buy it. Why? Because it's not worth $600,000. Okay. Now, if you're the agent, you're looking at the same thing. If you're a real estate agent selling a house for a couple, you want to get as high as a price as you can. So we're looking at the same data point, which is the price of the house, but you're looking at it from different perspectives. So when you take a finance class, it's very hard because if you don't know what hat do I have on right now, am I the principal or am I the agent? Then you get really screwed up. And that's where that diversification thing, I think, gets blown up and people don't understand it. So when we align business strategy and financial strategy, what we're trying to do is align the risk. So when business risk is high, when Gillette creates the electric razor and sells it to veterinarians, that's very high risk. If they were to do that, they want to have the lowest financial risk from the standpoint of the agent. So when Gillette's trying to find a low risk form of funding, they're going to go to what's called venture capitalists. And many of you, I'm sure, have heard of this in your other classes. Venture capitalists are usually, uh, yeah, we'll stereotype this one. Venture capitalists are usually people that started a company, um, got it to into that growth phase, took it public, and then made oodles and oodles of money, let's say $100 million. And now they're taking their loot that they got and they're going to go invest in other startups that they are knowledgeable about and that they can help and that, well, they know a thing or two about. So let's say a tech company goes public, it sells. The investor, the owner, the person, the founder, the creator then takes their $100 million and they go out and they find other startups that are trying to do something related to what they know about. So they pump money into that. Now, there's other type of venture capitalists where maybe it's not a millionaire or billionaire that has the money. Maybe it's a college professor that decides to start a private capital or private equity fund to fund small businesses. In the state of South Dakota, we have a business partnership. I think it's still in business that funds startups that are created at SDSU. So that's called venture capitalists. So when General Electric wants to try doing this, they want to get money from the venture capitalists because the venture capitalists assume that only 1 out of 10 of their investments is going to be successful. So what does that mean? It means if they invest $1 million in 10 startups, they know 9 of them are not going to make it. They're not going to survive. They're going to flame out. The one that does make it will make them another $100 million. Okay, if they're right, if they figure out how to solve the problem, and then can capitalize on it. So that's how venture capital works. So think about that. If an investor is expecting something to fail and to lose money, would you rather have that, or would you rather get money from your grandmother who is retired and has to depend on, an income from their investment or her investment? So the answer is you get your financial risk from venture capitals. Now, when this happens, when you're at these different levels of risk, which can be parlayed on top of the growth cycle or the life cycle, the funding in your financial strategy should be there should be certain markers and metrics. So, for example, a company should not pay out a dividend when its business risk is ultra high. Why? Because it needs that money to function. Jeff Bezos of Amazon was famously known for plowing back all of the money he made back into the company to grow it and grow it and grow it and grow it and grow it. And only till recently did he start saying, okay, now I'm going to retire. And now I'm going to be worth $100 billion. And now my ex-wife's worth $100 billion. And now I can go do whatever I want for a little bit. And I'll live off of some of that. Um, Only until then, though, before that, he kept plowing it back in because he was trying to create the biggest retail business or company in the world or whatever. So that when a company's not mature, when it's either in the early growth or growth situation, in the managers don't know what else to do with the capital or the excess earnings that are being kept because they don't have anything else to plow it back into the company, then the managers may choose as an option to pay a dividend to the investors and the stockholders. Now, from the investor standpoint, when they look at a company and they can tell when a company is all of a sudden sitting on millions or billions of dollars in cash, way too much cash relative to the operation, then the investors will say, look, that's not your money. That's our money. We're the owners. So you need to start paying that out. When a company does that and chooses to pay that a portion of the earnings out as dividend to the investors, what ends up happening is type of investors that buy that a dividend paying stock change. So when I said before, grandma would want to buy stocks that pay a dividend because grandma needs some money back from that investment to live off of. Okay. So she still gets capital appreciation, but she's getting a dividend from that. So when you pay out a dividend, you can't stop paying a dividend without it pretty much destroying your stock value or your stock price. So you're trying to balance these things. So when business risk is super high, you shouldn't be paying out any dividends. Hopefully, at that point, the future growth prospects should be very high. The price to earnings multiple should be very high. So when we looked at General Electric, we saw it was at 39, which is higher than 16, which would suggest it's very overvalued. Um, so if you were in the startup phase or the launch phase when business risk is really high, a high P&E ratio would make sense. Profitability, often you're burning through cash. If you ever see a company that has negative earnings and they've only just started, that's what's going on. They're burning through cash to see how they can figure out how to function and turn a profit. The share price at that point is growing rapidly and likely volatile. Next, we get into a high level of business risk. When we look at the Ansoff Matrix, I would say that, let's use this one, a high level of business risk would be starting to, if you were to somehow code it and analyze it, would be start to get close to the diversification, but not quite. Okay. In either one of these areas. Medium risk, I would say, would be products over here and markets that are over here where there's some knowledge known about it, but not a ton. So that would be a lower level of business risk. Oh, it's already on there. Sorry. Okay, so then we get into the business when business risk is high, then financial risk should be low. That's when you get growth equity investors. Who are growth equity investors? Mitt Romney, if you know him, Senator Mitt Romney from Utah was probably one of the most famous growth investors. I believe Bono from U2 is also a growth investor. These are investors that are trying to find these startup companies that have just barely started to figure out how to turn a profit and they're trying to figure out how to scale the company. So growth investors are buying in usually at either as an initial public offering or even before that, expecting that the stock price is going to soar and that the mature phase of business is a long way off. So we're trying to align a high level of business risk. You want a low level of finance risk, and that's where you get growth investors like Bono and Mitt Romney. Dividends should not be paid out when you're in the growth phase. All the earnings should be plowed back in. Future growth prospects should be high. The P&E ratio should be fairly high, but not obscenely high. Profitability, usually, if we look at the life cycle, usually you're somewhere, I would say, right in here. Okay. If you want to use this one, let's use this one. Okay, you're usually right in this area. You've just barely started figuring out how to make a profit. If you look at the cash flow model of this, you can see in the growth cycle down here that you might have finally started to having a little bit of net income. All right, next we get to the mature phase of business. So usually their business risk is medium, not high. You're getting pretty good at this. You understand how to do it. Then you should have a financial level, financial risk at about medium or the same level. Now, what does this mean? So we talked about venture capitalists. We've talked about growth investors. Now we're going to talk about institutional investors and debt. Okay. So, from the standpoint of the CEO, the agent, borrowing money from a bank has a little bit higher level of risk because they have to pay monthly payments or periodic payments plus interest. If they don't make those payments, then they can default, and the bank now is going to own a part of the company or force you to go through bankruptcy. So that's a medium to maybe even a high level of risk. So when you have medium level of business risk because you're in the mature phase of business, then that department or that product line should be using retained earnings. So that's internal money of the company and debt financing to fund that operation. So again, we're aligning the business risk to the financial risk. Dividends should be paid out if there's no other growth options to invest in. Anymore, most companies have decided that they want to continue to grow and grow and grow and grow and grow and find other options and opportunities to invest because that's what the investor wants. They want an ever appreciating stock price. Future growth prospects are usually nah, so because the company's in the mature phase of business. The P&E multiple starts normalizing between 16 and 25, I'd say. Profitability at this point is high. Why? Because we figured out how to do this and do it well. And as we saw in the life cycle, that's where you're in that that you're getting good at this. You know how to do this. It also gets to a point though that you've probably created a value discipline. You're probably the customer's buying for a certain reason, and it makes it harder for you to make bold adjustments when you're running the company. And diversification is, again, if you're an investor and you hear a CEO saying that, oh boy, they better have a plan because that's a no-no word. Share price usually is steady state. It's not going up or down by leaps and bounds. Last, what about the decline phase of business? Well, here you would want it since business risk is extremely low because you've been doing this for a long time. You know how to do it. You're pretty good at it. You want to allow your financial risk to be high. What does that mean? It means debt financing because it'd be like a restaurant, let's say here in Brookings, there's the Pheasant Restaurant who's been operating there since 1945 or something. They've been doing the same thing for, good Lord, 60, 70 years. They know what they're doing. They're good at what they do. They're probably not going to create a totally new menu tomorrow. Um, they know how to schedule, they know how much food to order, they know everything. So if they know everything and they can forecast fairly accurately the number of customers that are going to come in next week and the week after, then it makes a little more sense to go borrow money because they have the tools. And as long as nothing's changing and the customer preference isn't changing, then they should continue getting in business. Then it might make sense to use debt to finance some of that operation because there's nothing new happening necessarily that would throw a wrench into things. Everything becomes more predictable. So then you would use debt for that. When that happens, usually you would want a total payout ratio because what you're saying is, if you're the Pheasant Restaurant, we don't have any new ideas right now that are going to completely revolutionize, food consumption in Brookings, South Dakota. So future growth prospects should be usually not good because you're in the decline phase of business. You would still want to launch a new and improved 2.0 version of whatever you're doing. And that's when you go back and you would want to finance that with the appropriate level of risk. Profitability is probably low and declining, and share price is probably going down. So these are all, this is the application of life cycles, financials, the Ansoff Matrix to help us understand risk in its associated level. The higher the risk, the higher the rate of return that's required. Now, again, students kind of they mentally don't understand this very well when we talk about risk. Okay, when we say the higher the risk, the higher the required rate of return or the higher the earnings, when businesses and when investors are investing into businesses, we assume that the earnings are forecastable and they're foreseeable. They don't change. What does change is the price that's willing to pay for it. So if the earnings are steady state, okay, then it's the price that goes up and down and fluctuates. And that's why you're seeing this go up and down as I sit here. Um, the their the investor is basing how much they're willing to pay on this based on this $6.35 earnings that General Electric is earning right now on its stock. Okay, so if there is a super high level of risk, what that means is not that the earnings are going to be shifting and becoming certain super high. They're forecastable. So you have somebody in an office with Microsoft Excel that's doing linear regression and they're saying, okay, well, based on this previous product line, we think when we launch this new one, we should expect to receive or sell, you know, I don't know, 100 units next year. The year after that, 10,000 units. The year after that, 1 million units. Why? Because that's what happened in our last product line. So based on those numbers or those inputs, you're going to figure out, well, here's what we need to invest in. Here's the machinery, everything else. The question is, based on forecasting that with, because you don't have a shifting forecast. It's once the forecast is done, it's done. Then the question is from the investor or the agent, the CEO who's investing kind of internally in the company into this product line, they're trying to figure out how much are we willing to put into this to get those forecasted earnings out of it? And if the answer is not a lot, and you're going to get pretty high earnings, well, then they'd want to go through with the investment because to figure out if this is overvalued or undervalued, it's the same. A capital budget, which is the idea of trying to figure out which product line we should invest in, is it's the same thing internally as the CEO investing into a product line as it is to an investor looking at investing into a company. It's the same process. It's uh, discounting cash flows. Okay, so we've aligned all of those things. I would encourage you to go ahead and read through page, have that on there twice. I would encourage you to read through these documents one time through. I give you an example of hypotheticals. When a company is trying to figure out how to grow, I use Gillette. Then we talk about how you would try to figure out how to align the level of financial risk to the business risk of the venture and going through that. Okay, I am going to stop here because I need a drink of water, and I think this is probably long enough of a video. And we're still in chapter 2. We're going to just go through the rest of this master strategy tool stuff because you need to know it. All right, we'll see you on the next go around.